Good evening to you all. Please confirm that you can hear me. Am I audible?
Yes, you are.
All right, wonderful. If I'm audible, that's very good. So, my name is James from Varsity Unlimited Tutors. I am a private tutor. Most of you already know me from your first semester when we were doing microeconomics and many other modules together. So this semester, which is your second semester, I will be taking you through accounting. I'll be taking you through financial reporting and analysis. That's the module that we are gathered here today to do. So I'm just going to introduce some basics and then we can go straight into the module. So, financial reporting and analysis, or for the guys that are doing Become Accounting, Introduction to Financial Accounting, it's a module that basically introduces you to the concept of accounting, to the concept of bookkeeping or record keeping within an organization. So, any organization that is in operation needs to keep certain records of their financials, records of how much money came into the organization and how much money went out of the organization. So they need to keep records. And at the end of this module, each and every one of you should have a basic knowledge of how to do bookkeeping and how to interpret various financial reports and various financial statements, right? So that's key point number one. Key point number two is there are a lot of different of you from different degrees. Some are doing business administration, some are doing BCom in financial management, some are doing BCom in accounting and etc. For the majority of you, I will be the one who will be tutoring you from now until we finish. But for the guys that are doing BCom accounting, at a certain point in time, we are going to separate you into a different class because some of the material that you need to learn is a bit different from what the majority of the students need to learn. So we're going to create a separate class for those that are doing BCom accounting, I believe starting from next week or about 2 weeks from now. But for today, just for the introduction, I've combined you all together because what we want to talk about, it is basically the same thing. Right. Then the modus operandi, how are we going to do this? Because remember, for some of you, this is the first time that you're looking at accounting, and it could be quite a task. But we are going to make it a little bit easier for you. So for the next 3 weeks, which is today, next Thursday, and the Thursday after this, I'm going to be doing what I call introduction. So this will actually be a free class. So this week will be free. Next week again for financial reporting specifically, it will be free. Next week, but one again, it will be free. So what we'll be doing in these introductory free classes is number one, we are going to cover the theoretical aspects of what accounting is, what are financial statements, what are the roles of financial statements, who are the users of financial statements, and the different accounting standards that you need to know in order for you to prepare financial reports. Right? So that's number one, which is what we are going to do today. Then, number two, which is next week, we are going to introduce the calculation aspect of accounting, which means we are going to start with the numbers. We are going to talk about what is the accounting equation, what is a credit entry, what is a debit entry, what is a journal, what is a trial balance, what are the key terms, like what is an asset, what is a liability, what is an income, what is an expense, just giving you the key terms of accounting and a basic understanding of those key terms so that when we go into the deeper stuff, you have a basic knowledge which you can easily make you to understand. Then in week number three, that is when we start like the real core module, what is actually important. So right now, I'm just going to share for you an example of what your exam is going to look like. Just give me a minute. I want to share with you what your exam actually looks like. so that you can see, because I believe it's one of the most important things that when you are studying any module, you have an idea of what exactly are you trying to achieve? What knowledge are you trying to gain at the end of the day? All right. All right. So this is an example of a financial reporting and analysis exam. So you see what I was saying, that there's a lot of you from different degrees, right? So you can see over here, question number 1 says statement of comprehensive income. Prepare a statement of comprehensive income, which means that you need to know what is a comprehensive income, how do you prepare it from the information provided. So you can see it's a lot of numbers. It's quite a lot of numbers. So you really need to be patient in your learning, because it's a lot of numbers that we're going to do. So you can see here, number 2, it says here, prepare a statement of changes in equity. Again, lot of numbers. Number 3, prepare a statement of financial position. Again, lots of numbers. Number 4, prepare a statement of cash flows. Again, lots of numbers. Number 5, calculate some ratios. Calculate the below ratios. Again, that's a lot of numbers that you're going to do. And then a little bit of theory there at the bottom, 5.2, which says interpret or comment on the following ratios. So your exam is always going to be the same, right? You are always going to be asked to prepare a financial statement, right? Income statement. You're always going to be asked to prepare cash flow statement. You're always going to be asked to do ratios. So we already know what the template of the exam is. We might not know what the exact question is, but we already know what the template of the exam is. Therefore, that is what we are going to do in our learning from week 3 up until week number 10. So we are going to do almost like 7 to 8 weeks of going through each and every item that you are supposed to learn. So 2 weeks on the income statement, 2 weeks on the financial statement, 2 weeks on the cash flow statement, 2 weeks on the ratios and etc. for about 10 weeks. So that will take us up to around 9 October. Then from 9 October until you write your exam in November, then we can do some exam preparation, some past exam papers and etc. that we can then do, right? But while we are learning each and every week, we will make use of past exam papers as our examples in our learning process, so that you are familiar with how accounting questions are asked. Right. So that's the modus operandi. That's how we are going to be operating. Then, as usual, in terms of your assignments, you do not need to worry about your assignments. We will make sure that in the classes that we do, we will also ensure that we cover the assignments that you're going to face. And then for the exam, we are going to do exam preparation plus all of the examples that we are going to use are from the specific exams that you guys are going to be facing. So that will make your life a lot easier. So when it comes to the exam day, it means that you are adequately prepared. Right? Whatever the lecturer can send you, you're adequately prepared. Normally, for financial reporting, usual about half of the class can easily get distinctions if you pay attention to what we are doing. Half of the class can easily get distinctions. It's just that you need to attend, you need to pay attention, and if I give you homework, you need to do the homework. If there is anything that you do not understand at any point in time, please feel free to ask questions. Don't let the whole lecture go and then come next week when you did not understand what we did last week. At the end of the class, feel free, James, I've got a question. We can spend 10 more minutes or 20 more minutes attending to whatever question that you have, so that when we leave the class, everyone has an understanding of what we are doing. So that's my introductory remarks. Then for those of you that want to attend these classes, it's 800 Rand per module. 800 Rand per module starting in August. So make sure at the end of July, by 1 August, if you want to attend, make sure you reach out to me so that I can add you. I've got a separate group, a private group, for those of you that want to continue with the classes after the free period is done. So I think those are the basics. Now we want to start our learning process. So I'm gonna remove my video here so that I don't chow your data. I'm just gonna remove my video. and then we can start the class. So our starting point is, what is accounting, right? What is financial accounting? What is managerial accounting? And what are the key differences between the what? Between the two, right? So, okay, sorry, wrong slides. Apologies for that. Let me open the correct slides. So the ones that I was opening, those are for lesson number 2. Let's go to lesson number 1. Just a second. All right, lesson number 1. So what is financial accounting? What is managerial accounting? And what are the key differences? So when we are looking at accounting, now this is not a question that will come in your exam, but this is for your basic understanding. It might come through on the assignments, but it's just for your basic understanding. So don't worry about cramming this theory. It will not come in your exam. It's just basic understanding that will enable you to understand better. So when we are saying accounting, we are just talking about the process whereby an individual who is working, let's say, at Coca-Cola, or who's working, let's say, at Tiger Brands, measures, processes, and communicates financial information, right? So, for example, a person measures how many Coca-Cola bottles were sold by the organization, then processes and says, oh, we sold them at a price of 10 rand and they were 1,000. Therefore, our sales, our total sales for the week was 1,000 rand. So he has measured the number of bottles, he has processed the information, that is the quantity and the price, and he has communicated the information in form of one figure, which is the sales of the organization for that particular week. So that's what accounting is all about. It's about measuring, processing, and communicating financial information for an organization. Right. But when you go to your second year, you are going to do a module called management accounting. So the difference now between financial accounting, which is what you are doing this semester, and management accounting, which you are going to do next year, is management accounting is about making decisions, whereas financial accounting, it's about reporting, or it's about communicating financial information. So that is why actually the module is called financial reporting, right? Whereas managerial accounting, it's about decision making within the what? Within the organization, right? So that's the key difference between the two. So because of that, financial accounting mainly relates to people that are outside of the organization. It relates, to the government, it relates to shareholders, it relates to your suppliers, it relates to your investors, and etc. Whereas management accounting relates to people that are inside of the organization, which is your employees, the owner of the business, and the managers of the business. Then the last key difference is financial accounting is based on standards, which we are going to look at later in the lecture today. It's based on certain standards that everyone who does accounting agreed on, so that every financial statement that is provided is going to make life very easy for everyone. Right. So that's the key differences between financial and managerial accounting. Like I said, this is not going to come in the exam. This might come in your assignments. We're going to deal with that later on, but it's just so that you have a basic understanding of what we are talking about. Now, let's go into the key thing for today. Though, if you have to learn anything today, what we're about to do now is what you need to capture in your mind, right? So, when an organization is operating, they have what we call financial records. So when I say financial records, for example, right now, if you're working for a company, if you go to the accountant of your organization, he will tell you that he is recording, right, all of the transactions that you're doing in the cash book. He's recording all of the transactions that you're doing in the purchases journal. He's recording all of the salaries that he's paying in the payroll. So those are financial records. They contain information about the various transactions that are happening within the organization. Now, at the end of the year or at the end of the month, depending on the organization that you're operating, the accountant or the bookkeeper or the finance manager is going to take all of the information within the financial records and prepare a formal report that he can give to either the owner of the business or the CEO of the company and etc. This formal report is what we refer to as financial statements. Now, there are different types of financial statements. We'll talk about them in a minute. But the formal report prepared by your accountant, prepared by your bookkeeper, which shows you the financial performance of a company, is what we refer to as financial statements, right? As financial statements, right? So that's the key definition of what is a financial record and what is a financial statement, right? Let's go a step further. So for the rest of this semester, you are going to be looking at financial statements. That's the key thing that you're going to be looking at for those that are doing financial reporting and analysis. Then for those that are doing BCom accounting, you are mainly going to be looking at financial records and also partly financial statements. But for most of the guys that are in this class, we are going to be studying financial statements. So this is your introduction. Financial statement number one is called the statement of comprehensive income, right? There are 5 key things about financial statements, 5 financial statements. So financial statement number one is called the statement of comprehensive income. This financial statement will be there in your exam. We are going to spend about 2 weeks learning about the comprehensive income, right? I'm going to share my notes. We're going to do examples and etc. But it's 100% there in the exam. So what is a comprehensive income statement? A comprehensive income statement is a report that shows the financial performance of the organization, usually over 1 year. It shows whether your company made a profit or your company made a loss during the financial year. If you open a statement of comprehensive income, this is an example of a statement of comprehensive income. It will show you the revenue or the sales of the organization. How many items in terms of the value did we sell? We sold 1 million, right? That's the amount of money that we received. Maybe we are Albany bread. That's the amount of money that we received when we sold our bread to Pick and Pay, to Spar, and all of those shops. So it shows you the sales of the organization. It shows you the cost of sales. How much money did we spend to buy flour for us to make the bread? It shows you the expenses of the organization. How much money did we pay our salaries? How much money did we spend on cleaning? How much money did we spend on rentals? It shows you interest, income, and expenses. How much money did we pay to FNB for the loan that FNB gave us to start our business? It shows you the taxation. How much money did we pay to SARS for tax for the year? So that's the comprehensive income statement. The key figure is the last figure, which is the net profit or net loss for the year. So that is your comprehensive income statement. Again, like I said, it shows you over a period of time. For example, 1 year. It shows you that this is the financial performance, underlying the word financial performance of the organization over a period of time, for example, 1 year. Right. So that's financial statement number one. Financial statement number two is called a statement of financial position. A statement of financial position. This one, it's a financial report that gives you the value of the organization. It gives you the financial position or the snapshot of the financial standing of the organization on a specific date. I want you to see the difference. When I said financial, when I was talking about the income statement, I said financial performance over a period of time. But when I'm talking about this one, statement of financial position, I'm saying on a specific date, at a specific point in time. It's not over a year, it's over one day. We're saying that on this day, this is the financial position of the organization. On this day, this is the snapshot of what the company looks like. So within a statement of financial position, you are going to find the assets of the organization. For example, it will record, okay, this company has got buildings that are worth 500,000. This company has got 2 vehicles that are worth 150,000. This company has got some stock, some inventory in the warehouse. This company has got some cash in the bank, which is 5,000 Rand. Then those are the assets of the company. Then it will also show you how those assets were financed. How did we buy those assets? Where did we get the money? Right? That is the equities and liabilities. It will show you that, oh, we took a bank loan of 100,000 for us to be able to buy these assets. Or we have not yet paid our taxes. We owe SARS 10,000. We owe our creditors 50,000. The owners of the business invested 500,000 for this business to start. So that is the statement of financial position. It gives you key information with regards to the assets, with regards to the liabilities, with regards to the equity of the organization. So some of these terms that I'm talking about, I know if it is your first time doing accounting, you say, hey, James, what is an asset? What is a liability? What is equity? What is all of these things? Don't worry. We are going, remember what I said in week number 2, which is next week, we are going to look at all the key terms that you need to understand for you to be able to do accounting. We're going to look at them, all of them next week. For now, we just want to go through the theoretical aspects before we start on the calculations, because these things are tied in to the calculations. So statement of financial position gives you the value of the company. It gives you a snapshot of the financial standing or the financial position of the company. It shows you whether the company is stable or whether the company is not stable, whether the company has money or whether the company does not have money, whether the company has got enough resources or the company does not have enough resources. Other textbooks will refer to this as the balance sheet. So statement of financial position, it is also known as the balance sheet of the organization. Right. Financial statement number 3 is called the statement of changes in equity. So if you want to start a business, right, you have to put money in the business. Right. So for example, I want to start my own business. I want to maybe do trucks, haulage trucks, right? I have to invest maybe 3 million Rand for me to buy maybe 4 trucks or 3 trucks that I want to what? I want to buy. Maybe they're second-hand trucks, right? So that money that I have invested in the business is what we call the equity of the organization. Now, because I am the owner of the business, after 2 years, maybe I might want to add more money on the business, or I might want to take out some of the money in the business. This statement of changes in equity records for you every year what the owner of the business contributed to the business, and every year what the owner of the business took out of the business. This is an example of a statement of changes in equity. Right. Then financial statement number 4 is the statement of cash flows. So statement of cash flows, it only records cash transactions. You understand this one better next week when we talk about accrual accounting and cash accounting. That's when you understand this. A statement of cash flows, it records only cash transactions. Did we receive cash? Did we pay cash? That's basically what it records. Anything else which is not a cash transaction should not be found within a statement of cash flows. So it shows us the movement of cash in and out of the organization, the ability of the organization to generate cash. How much do we use cash within an organization? Therefore, it is a good measure of whether as a company we are financially flexible. So, for example, I'm sure you guys know, those are small to medium enterprises where month end, the owner of the business says, I don't have money to pay salaries right now. I'll pay you guys next week. It's not because the company is not making profit. The company is making a lot of money, it's making profit. But that owner of that business failed to prepare the statement of cash flows. Because if he had prepared the statement of cash flows, he would have already seen that in October month end, I will not have cash to pay salaries. So let me save cash right now so that I can pay my salaries on time. So that's one of the things that this statement can help you with within an organization. Right. So this is an example of a statement of cash flows. Then lastly, number 5, there are what we call notes. My mistake, there is not noted, it's notes. They're what we call notes to financial statements. Notes to financial statements is whereby after you've prepared all 4 financial statements, you then have got like 3 or 20 pages where you explain certain things. You explain the accounting policies that you used. You explain anything that is not in the financial statements. For example, in a financial statement, you will never see where it says we have got 20 employees. But under the notes to financial statements, it will say the wages and salaries of 200,000 was paid to 20 employees. 15 of them were managers, 10 of them were not managers, something like that. It gives you more detailed information about the financial statements that you have presented. This one, we are not going to talk a lot about it. For those that are doing BCom accounting, I think you talk about this more in your second and in your third year, the issue of the notes. But for everyone else, this one we're not gonna really talk about. We're gonna talk about the other 4 financial statements. All right, so those are your key financial statements. And like I said, the exam that you're going to write at the end of the semester. Question number 1, income statement, prepare. Question number 2, in a statement of financial position, prepare. Question number 3, statement of changes in equity, prepare. Question number 4, statement of cash flows, prepare. And then question number 5, those are ratios, that's analysis. We're going to talk about that at a later stage. Right? So there are always those 4 financial statements will always be in your exam. Now, let's put them aside. Let's talk about when we prepare financial statements, who do we give the financial statements to? Who is going to use these financial statements and why do they want the financial statements? So there are people that are within the organization. So these are your owners, your employees, and your management. So for example, if you prepare financial statements, the owner of the business, the reason why he wants financial statements is he wants to see if we are making a profit as an organization. He wants to see should he add more money or he can withdraw some money out of the business. The employee of the business wants to know that are we making enough money? Will I get my salary? Or maybe we're making too much money. Maybe I can negotiate for an increase in my salary. Or maybe I need to run away from this company. This company is going to close down next week because they do not have money. So that's the employee of the organization. The manager of the organization needs financial statement because they need to budget, they need to forecast, they need to evaluate whether the performance of the company this year is better than the performance of the company last year. And they need to know where should we put our money, which businesses are making more profit so that we can put our money there if the business is operating different types of what? Different types of businesses. So those are internal people within the organization. External people, these are your investors, your bankers, your creditors, your government, your auditors, and etc. So, for example, the government wants your financial statements so that they can calculate your tax, they can calculate VAT, they can calculate your income tax that you are supposed to pay as an organization, right? Creditors or your suppliers want your financial statement because they want to know if we say pay us in 90 days, will you have the money in 90 days to pay us? Or maybe you are just, you are one of those organizations, after 30 days, you are closed. So they will not give you credit if they see that you don't have financial statements. Bankers, why do they need financial statements? Maybe you want to apply for a loan. They'll say, give us your financial statement so that we can assess whether you are someone who we can borrow money to, who's going to pay it back, or someone who is not going to pay it back. So I'm going to share these notes, right, in the group. So you can see some of the things that I'll be skipping and etc. I'm trying to manage our time. I'm going to share these notes. You can also go through these notes because this is just theory, right? So like I said, this is not in your exam. Internal users, external users, this is not found in exam, but you might find it in your assignment. Like I said, assignments, don't worry, but this is not in exam. It's just so that you understand what we are talking about. All right, then, yes, I think this is where we are going to rest our case for today. So this is now accounting standards or rules of accounting or concepts of accounting. Now, this is very, very, very important. Although you will not find an exam question that says what is GAAP, that says what is IFRS, or what is the key concepts, but everything that you do in the exam is based on accounting rules. It's based on accounting concepts. When we say prepare a financial statement, you prepare a financial statement according to the rules of accounting. If we say prepare an income statement, you prepare an income statement according to the rules of accounting. And that's what we want to look at today at the moment, right? So, rules of accounting. Okay. So, there are what we call generally accepted accounting principles. So this is basically like a framework that was created by some accountants a long, long time ago, that when you are preparing a financial statement, this is what you need to do. This is the format that you need to follow. These are the calculations that you need to do, and etc. So that's what it means, generally accepted accounting principles. It's just saying when you are preparing financial statements, these are the things that you need to follow. So this is a worldwide thing. So after this was prepared, then there was an organization called the International Accounting Standards Board, which then created what are called International Financial Reporting Standards, which is what the formats that we'll be using are based on. The first thing that came was the generally accepted accounting principles. That's the first thing, that's the core. But after that came through, then the International Accounting Standards Board then prepared the International Financial Reporting Standards. For everyone else, don't worry about this. For those that are doing BCom accounting, there is a module in your second year where you learn about that. Right? But for everyone else, we are more interested in the generally accepted accounting principles. So, principle number one, right? When you are preparing financial reports, all four of them, you observe what is called the accounting entity concept. So what does that mean? When I say accounting entity concept, I'm saying only the transactions that represent the company should be recorded and nothing else. So I'll give you an example. Me, I am James, right? So James owns a company. James' company is a company that manufactures, let's say, furniture. I manufacture sofas, tables, and etc. I manufacture furniture, beds and whatnot. That's my company, right? So when I am recording financial information, I should only record financial information that relates to the manufacture of the tables, that relates to the sofas, that relates to the beds and etc. Nothing else should be recorded unless it relates to the company. So I'll give you an example. Because I am James, I am the owner of the company. Let's say that there is 1 million rand in the company account, right? There's 1 million rand in the company account. And then the school where my child is makes a call and say, James, you have not yet paid your school fees. Urgently pay school fees or we are chasing your child out of school. What do? I go to my business account, I transfer 30,000 to the school. I've paid school fees for my child. But the fees that I paid out of the company account Is that a business transaction? No, it is not a business transaction. It is a personal transaction that I have transferred out of the business account. So I cannot go on and record in my books and say the expenses of James manufacturers and then say 30,000 school fees for a child. That's wrong. It's not an expense for James manufacturers. It's my personal expense. I do not record it that way. The way that I record it, I record and say, James took money out of the business, 30,000. That's what I record. James took money out of the business, 30,000. Then it means that that is a withdrawal of the business. It is not an expense of the business. So that's the accounting entity concept. Example number 2, right? We at James Manufacturers, we have got a warehouse where we keep everything, stationery and whatnot in the warehouse. Then my wife comes to the company and says, "Oh, my husband, I am in need of some cleaning materials. I want to go and clean at home. I am in need of some cleaning materials." Instead of me giving her money, I say, just look at that warehouse there, that storeroom there. There is jig and domestos in there for the company that I bought 2 years ago. Go and take it and go and clean home. I cannot record at the end of the year and say James manufacturers spent 50 Rand on domestos, because it was not James manufacturers. It was me and my wife that spent that money. So it means that I have to record things in a particular way. So that's the accounting entity concept. Only the transactions that relate to the entity or that relate to the organization should be recorded. Anything else that is not part of the organization, there is a different way of recording it, but not within the financial statements of the organization. So that's rule number 1. Remember what I said: if there's something that you don't understand, always feel free to ask. Rule number 2, money measurement concept. Money measurement concept is straightforward. You cannot, remember, you cannot say financial position statement. I have got 22 tables, I've got 3 beds, I've got 42 chairs, I've got some. You can't record things like that in accounting. You don't record the number of items, you record the value, right? If I have 22 beds, what is the value? If the value is 30,000, I just record beds 30,000. If I've got 10 cars, I don't record I've got 10 cars. What is the value? If the value is 2 million, I just record motor vehicles 2 million. That's the money measurement concept. Anything that we record in accounting, we record the value, the money. We don't record the actual item to say there are 5 items or there are 20 items. We record the money. And when we are recording the money, we record as one currency, the South African rand. I do not say I've got some euros, I've got some Chinese yen, I've got some US dollars. No, I only record in South African rand, which means that if I have money that is not South African rand, I convert it at the exchange rate and record it. So that is the money measurement concept. All right. So if someone comes to my company and say, James, let's say maybe I'm doing real estate, I sell houses, and they say, James, I want a house, but I don't have cash. But I have got I've got a lot of cars. I've got new cars that I've got. I've got some odd, some bands. I've got new cars. I can give you 5 new cars for your house. What do I do? Do I record that I sold my house for 5 new cars? No, I record the value of the 5 new cars. That's what I record. So that's the money measurement concept. Concept number 3 is the materiality concept. The materiality concept simply states that, I want to show you something here. Sorry, let's go back a little. I want to show you something which best explains the materiality concept. So, do you see in this example of my statement of comprehensive income, I said here, less operating expenses, and I said 300,000. And then do you see down there, I said many items under operating expenses. What have I done there? I'm telling you that under my operating expenses, there were wages, there were salaries, there was stationery, there was water and rates, there was rentals, and there was. Why did I not record it? Because maybe if I wanted to record it, it would have been 3 pages worth of information. So that's what we are talking about when we are talking about the materiality concept. We are saying when recording transactions, smaller things that don't matter do not necessarily need to be recorded one by one. You can record and say stationery expenses. You don't have to record and say paper clips, bond paper, pens, pencils. No, you don't need to do that. You can just say stationery and add everything under stationery there. You can just say motor vehicles and add everything under motor vehicles. You don't need to record trucks, sedans, vans, and whatnot. You don't need to do that. Just one entry. Buildings, 500,000 is fine, even if there are 20 buildings. So you don't need to record little by little by little by little. You can sum up and categorize things into single values to make your life easy. So that's concept number 3. Next concept is the historic concept. Now, this one is a bit confusing for many people that are not doing accounting, but it's a straightforward concept. When we record things, we record at the original value of the thing. So if I buy a house today, or if I bought a house in 2015, and the house was costing 500,000 in 2016, right now today in my financial reports, I will record the house 500,000. That's what I will record, right? That's the historic concept. I will record it 500,000 hours. Even if right now, if I was to go on the market and sell that house, I can get probably 1.5 million, but I'm not going to record 1.5 million because I'm not selling the house. If I'm going to sell the house, yes, I can record 1.5. But because I'm not selling the house, I record at the original historic cost. However, in brackets, historic cost less depreciation that has been established. When I say depreciation that has been established, for example, a car. If I bought a car 5 years ago, it loses value because I have been using the car. So that is depreciation. So I have to subtract it from the historic cost of the asset. So that's the historic cost concept. The next one, double entry concept. This one, you understand it better next week. Double entry, it simply means that when we are recording in accounting, we record everything twice. That's basically what it means. We record everything twice. For every debit entry, there is a credit entry. We are going to talk about what is debit, what is credit next week. So we record everything twice. Each entry is recorded twice in accounting, right? Then going concern concept. When we are saying a business is a going concern, we are saying a business will continue to operate for the foreseeable future. It's not closing down tomorrow. It is not closing down next week. It is not closing down next month. That's what we are saying. So when we are doing our record keeping, our assumption is the business is going to continue to operate. And that is the reason why we use the historic cost. If we know that this business is going to close tomorrow, we can no longer use historic cost. If we know that the business is not a going concern, we can no longer use historic concept. We will talk about this more when we start doing the calculations. Then, accounting period concept. So this one, what we are basically saying is that every business is an accounting period. For you guys, the accounting period is 1 year, right? I know some businesses will do 6 months, some businesses will do 1 month, but for you guys, it's 1 year. And that 1 year, some questions will say January to December. Some questions will say the year is January to December, but some questions will say the year is 1 March up to 29 February. So 1 March this year up to 29 February next year. That's 12 months. So just be careful about that. Some questions will say January to December. Some questions will say 1 March up to 29 February. They will be there. The information will be straightforward. Don't worry. But it's just something that you need to be careful about. But in short, the accounting period is 1 year for you guys. Then now we are getting into interesting stuff. Now, this is something that you're going to see a lot of. This concept, matching concept, and this concept, accrual concept, you are going to see a lot of them, right? So when we are saying matching concept, I want you to think of a company, a contractor, right? You are a contracting company. You have been given a tender to build the road. Maybe you have been given the tender to build a road from Durban to Port Elizabeth. That's the road that you've been given to build. You check and you see it's going to take me 3 years to build this road, right? It's going to take you 3 years to build the road. Then the government gives you all of your money, 3 billion rand, right there and there, cash. Here's your 3 billion rand. How do you record that 3 billion? Do you say in year number 1, I made 3 billion? In year number 2, remember, you're still building the road. I made 0 money. In year number 3, you're still building the road. I made 0 money. Do you do that? No, you don't do that. Because it's going to take you 3 years to build the road. You're going to divide 3 billion divided by 3, 1 billion in year number 1, 1 billion in year number 2, 1 billion in year number 3, or whatever method that you're going to use. But I'm saying that you're going to match your things around. So that's matching concept. You take the revenue of the company and you match it, because you need to pay salaries in second year. You need to pay for machinery in the third year. So you're going to match the expenses in each year to the revenue that you already received for that particular year. So that's the matching concept, right? Then let's also do the accruals concept. Accruals concept, we are saying, think of it this way. Right now at your company where you are currently working, you have got buildings that you are renting. I'm assuming maybe you bought the buildings, but let's say you are renting the buildings. And then you have a bit of a problem with money. And then you don't pay your rentals for a whole year, right? And then you pay the rentals next year. So when you prepare your income statement, do you say we did not have rentals this year because you did not pay rentals? No, that's a lie. You had rentals, you owe rentals. So you have rentals for this year, you just didn't pay them. So you actually record and say expenses for 2025. I have 100,000 in rentals. Then you go and record in the financial position and you say people that I owe, which is your creditors, and you say I owe the landlord 100,000. That's how you record it. Right? So according to the accruals concept, as long as you have enjoyed the benefit, as long as you have used the property, as long as you have used the electricity, as long as you have used the water at the company, as long as you have enjoyed the benefits of the item, the fact that you have not yet paid for the item is not important. You still record those expenses and you also record that you owe those people money this year. That is the accruals concept, right? And then realization concept is the issue that if you don't receive money that you were supposed to receive, do you ignore it? So for example, I'll give you an example of example can I give you here? Okay, so a business is operating on credit, right? Mr. Price, right? They are selling clothes on credit. You come and take, let's say, 5,000 Rand worth of clothes from Mr. Price, and you say, I will pay you guys next month, right? And then at the end of the month, do they record that they made a sale or should they not record? They record. we made a sale of 5,000 rand. The person said they'll pay next month, but we made the sale this month, this July. So that's realization concept. We are saying that even though you have not yet received the actual cash from the person who bought the clothes, but you have to realize the revenue this year because it's your money that you are going to receive later on. Then lastly, conservatism concept. Conservatism concept simply states that don't overdo things when you're doing accounting. Make sure that your profits are low. Make sure that your asset valuations are not what? Are not overestimated. Right. So which means whenever you are using judgment to do something, make sure that your judgment is not overestimating. You are not saying, oh, we made a profit of 5 million when you didn't really make a profit of 5 million. So make sure that you are conservative in anything where you have to use judgment, in anything where you have to use estimation. You are going to see there's something called provision for bad debts, which is going to confuse all of you, but we're going to talk about it. Mainly uses this concept of conservatism. So those are what we call accounting concepts that you need to understand when preparing financial reports. Now, I know we went through this, probably 3 of you really understood what we're talking about. But as we prepare the financial statements, I will remind you that here we are applying the matching concept. Here we are applying the realization concept. Here we are applying the accruals concept. So by the end of the semester, you will understand these ones better. It's just that before we start doing it, we need to tell you what it is so that when we talk about it later on, you can refer back to it. Right. So in conclusion now, are there any limitations in terms of financial statements? Are there any problems that we face when preparing financial statements? Problem number one, remember historic cost. Like I said, if I bought a building 5 years ago, 500,000, obviously it's no longer worth 500. It's now worth 1.5. So what are we doing if we are recording it as 500 when it's worth 1.5? So that's one of the problems of accounting, right? Problem number two, it's inflation. If you're operating in a country where the price of tomatoes at the beginning of the year was 10 rand, in the middle of the year is 20 rand, at the end of the year is 30 rand, your financial statements are useless because they cannot be compared, because they make no sense, because the value of the product is constantly changing. So there's actually what is called accounting for hyperinflationary environments that you might need to learn later on, but not now. But later on, you might need to learn about it. So that's problem number two. Problem number three, remember we said that in accounting, we don't record how many cows or how many employees or how many cars do you have. We just record the value. So that can be deceiving. For example, I can say the company has got 32 million worth of buildings. But if you don't know how many buildings, you can't really tell whether my company is successful or not. Maybe it's just one building that is just expensive. Or maybe I've got 20 buildings that are small by small. You see what I'm saying? So that's one of the problems. It's because we don't record anything that has nothing to do with money, it becomes a problem, right? We don't record whether our employees are happy, whether our customers are happy. We don't record all of those things. And those things are important. We don't record how many awards did we win and etc. We don't record how many branches did we open in accounting. That's nothing to do with us. So that becomes a problem. But remember what we said, notes to financial statements. So that's the reason why we have notes to financial, to try to solve for some of these things. Then number four, financial statements are about the past. They have nothing to do with the future. They tell you how much profit we made last year. They tell you how many buildings we have right now, but they do not tell you what is going to happen 2 weeks from today. If 2 weeks from today, the government is going to take everything that we have, it's not found in the financial statement. You will never see where it says in the financial statement, okay, 2 weeks from today, the company is going to close. So that's one of the problems of financial. Again, we solve it through the notes, but that's one of the problems. It's always looking at the past of the organization. Right. Then these ones, I recommend you can go through them yourself. the characteristics of financial statements. What is a good, if you want to say something is a good financial statement, what are we talking about? We are saying that if I read it, I easily understand what the organization is trying to tell me. I can easily tell whether the company has made a profit or whether the company has made a loss. If I read through it, I can see that the information provided is relevant for decision making. If I read through it, I can see that the person who was doing this financial statement, he was neutral. He was not biased. He was not trying to sell my company, therefore put too much profit and etc. He was a very, very what? A neutral person. They are complete. Everything that I need is there. They are comparable. I can take the financial statements and compare them with other companies. So those are the characteristics of a good financial statement. So, ladies and gentlemen, this is our lesson number 1. I will send you these notes. These notes are a little bit more detailed than what is in your study guide. But if you want to go and read your study guide, read unit number 1. That's where we were looking at. So next week, we will still be in unit number 1 next week. We'll still be in unit number 1 next week, but we'll be looking at something a little bit different from what we did today. So today it was mainly theory, and we are done with theory. We're not going to come back to theory again. We are done with theory. So next week when we meet, like I said, we are looking at key terms. What is an asset? What is a liability? What is income? What is expense? What is equity? We're going to calculate the accounting equation, right? The assets is equals to equity plus liabilities equation. We're going to calculate it. We're going to do bookkeeping. What is a credit entry? What is a debit entry? How do we record that in the journal? How do we record that in the cash book, and etc.? And what is a trial balance? How do we record a trial balance? So that's what we will be doing next week. All of this thing is, we are just setting a foundation. Remember what I said? This will not be in your exam the way it is. We are just setting a foundation. The stuff that will be in your exam mainly, we're going to look at it from week number 3 up to week number 10. That's when we'll be dealing with the questions that are in the exam. For now, we just want you to understand what accounting is so that you can understand us better when we talk about accounting. So if you want to join our classes, feel free to send me a message. I'll add you to our private group. Remember, there is a cost attached to this, 800 Rand for the entire semester. You can pay in installments, maybe 200 Rand a month or 300 Rand a month. That's up to you, right? We can talk about it on my WhatsApp. But this week, next week, it's going to be free because it's just introduction. I won't charge you to do introduction. But after we have done with the introduction, when we start doing the actual workings, when we start doing past exam papers and etc., there will be an extra charge for that. And like I said, if you follow through these things, most of the time you end up with a distinction, because accounting is an issue of practice. As long as you do a lot of practice with me, you will be fine. But if you skip classes and what, I can't promise you. But if you follow through what we are doing, most of the students that I teach, about half of the class, most of the time, they have distinctions in accounting. Even if it's their first time learning accounting, they usually end up with a distinction. Why? Because we focus on the exam. I know some of you remember from our economics, I think almost like 10 questions are in the exam were part of the stuff that we did in our. So that's exactly what we do. We focus on the exam as much as we can so that when it comes to the exam day, you are well prepared to do your accounting exam. Any questions before I go? Our next lesson, there is a lesson on Monday for macroeconomics. Just take note. There is a lesson this coming Monday for macroeconomics. I will send the links in the group, but there is a lesson on Monday for macroeconomics. Just take note. All right. Good night, everyone.
Thank you, James.